Hey everyone, welcome back to Alpha Node. I'm Roy. Today is March 2nd, 2026, and we are waking up to a world that changed dramatically over the weekend. On February 28th, the United States and Israel launched a massive coordinated strike on Iran. Code names Operation Epic Fury. Iran's supreme leader Khamenei was killed, and the Strait of Hormuz has been effectively shut down. In the middle of all of this, Bitcoin crashed to 63K on Friday night and then bounced hard. Right now, I'm recording this. It's trading of 69K. And today I'm going to break down the three key forces driving this rally, the critically technical levers you need to watch, and where I think this goes from here. Let's get into it. Here's what we are covering today. First, we will look at the raw numbers, what exactly happened this weekend. Then we will analyze the three drivers behind today's rebound. After that, I will walk you through the key technical levers on the chart, and finally we will lay out the bull, bear, and the base case scenarios going forward. Let's start with the numbers. All right, let's set the stage with the data. On Friday night, when the first report of U.S. Israel airstrikes on Iran hit the wires, Bitcoin cratered to an intraday low of 63K. The fear and the greed index dropped to 13. That's lower than the COVID crash in 2020, lower than the FTX collapse in 2022. We are talking about the levels of fear we basically never see. But then, by Monday morning in New York, Bitcoin had recovered to roughly 67 $200, and that's a 6.5% move in under 48 hours. Textbook V-shaped recovery. Meanwhile, WTI crude oil surged above 6% to above $71 a barrel. Ship traffic through the Strait of Hormuz, which handles about a third of world's seaborne oil exports, dropped by 70%. Now here's the key context. Bitcoin is still down 47% from its all-time high of 126K, set back in October 2025. This is the fifth consecutive red month, the worst streak since the 2018 bear market. And yet, US spot Bitcoin ETFs just snapped a 5-week outflow streak, recording over 1.1 billion in net inflows across 3 straight days. BlackRock's IBIT alone observed 652 million of that. So the picture is clear. Retail is selling fear. Institutions are buying the dip. The drivers. This rally is the first driver, the digital gold. The first driver behind this rally is the let me walk you through what's actually happened on the ground. How many was killed in the U.S. Israeli strike? Iran's revolutionary guard has effectively shut down the Strait of Hormuz. Ship traffic is down 70%. Saudi Aramco's Ras Tamura refinery, one of the largest in the world, was temporarily shut down after an Iranian drone strike. What does this mean in real numbers? Roughly the 20 million barrels per day of oil are at risk. That's about 20% of all seaborne oil trade globally. Oil prices are surging. Gold blew past $5,400, adding nearly $1 trillion in market cap in just 6 hours. But here's the thing. Not all of that capital is going to gold. Think about it from the perspective of a wealthy individual in the Gulf, or a sovereign wealth fund in the region. In wartime, bank accounts can be frozen. Gold bars are heavy and hard to move across borders. Bitcoin is unsizable. It crosses borders in seconds, and its supply is permanently kept at 21 million coins. The war inflation hedge narrative, which people dismissed as crypto bro and fantasy for years, is suddenly the most rational trade on the board. Driver second, the short squeeze. And driver number two, the 323 million short squeeze. The derivatives data tells a violent story. Let me break down. Perpetual swap funding rates had collapsed to negative 6% annualized. 3 months low. 3 months low. What does that mean? It means an enormous number of traders were betting on further downside. Betting on downside. They were filing into shorts, but at the same time, open interest actually increased to 887,000 BTC. So price is falling, but OI is rising. That's not existing long getting liquidated. That's a fresh short capital entering at the bottom. It's the classic setup for a trap. And that's exactly what happened. When the bounce started, those short positions got forced liquidated. Over 323 million worth in a single move. And here's the thing. Uh, Forced liquidation means forced buying. The buying pushes the price up, which triggers more liquidations, which creates more buying. It's a self-enforcing loop, the textbook short squeeze. And it's not over. There's an estimated 4.3 billion in short exposed clustered between 70K and 72K. If Bitcoin can push it through that zone, expect a violent move toward 75K to 80K. Third driver, the institutional front running. The third driver is what I'm calling institutional front running, or Arthur H. thesis. The logic chain is simple. Look at this flow diagram. War is expensive. Wars in the Persian Gulf is catastrophically expensive. The fiscal deficit explodes, and when the government needs to fund the war, eventually the fund gets directed back into quantitative easing. Printing money, injecting liquidity that devases the dollar, and the hard asset, gold, Bitcoin, goes up. And this is the scenario also Hedge has been laying out for years, and now it's playing out in real time. Let me show you the evidence. First, the ETF flows 1.1 billion in net inflows over 3 days. BlackRock's IBIT pulled in $652 million. Grayscale's GBTC posted its biggest single day inflow since it converted from trust to an ETF. This is not retail money, this is institutional capital. The second, the CME open interest is actually declining and down to 107,780 BTC. Why does that matter? Because on the CME, institutions can run basis trades, wrong spot, short futures. If CME OI is falling while ETF inflows are surging, it means this buying is pure directional long exposure, not arbitrage, real conviction. Third, the Coinbase Premium index turned positive for the first time in 40 days. Historically, this is one of the most reliable signals that US institutional demand is returning. Let me sum this all up in one sentence. The coins that retail panic sold at 63K over the weekend are now being observed by Gulf sovereign wealth funds and the US institutions hedging against the very war inflation those retail sellers feared. The irony is almost poetic. The word that made retail sell is exactly the reason institutions are buying. Technical landscape. Now let's look at the technicals. I've read up the key levels in this table. Starting from the bottom, the $63,000 is the local double bottom that formed this weekend. The fact that this level held under an extreme geopolitical shock is significant. $68,000 is the 200-week exponential moving average. If Bitcoin can close a weekly candle above this level, the bullish structure remains intact. The most important zone is between 70,000 and 72,000. This is where the 4.3 billion in short positions clustered. If this wall breaks, we get a cascading liquidation event that could propel Bitcoin to 75K and potentially 8K. On the downside, 60K is the line in the sand. A break below that opens the door to a deeper correction into the mid 50K range. One more key insight at the bottom of the slide. Semi-open interest is falling while ETF inflows are surging. That tells us this institutional buying is outright long exposure, not basis trade arbitrage. This is structural damage. Let's close with three scenarios for where this goes from here. The bull case, the Hormuz crisis extends beyond a few days, and all indications suggest it will. Oil pushes above $100. The world inflation trade intensifies. The Fed is eventually forced to ease the $4.3 billion short squeeze cluster at 70K to 72K fires, and the Bitcoin cascades toward 75K to 80K. Analysts at Mercado Bitcoin suggest the BTC versus gold, the bottom may already be confirmed, with the recovery starting this month. The bear case, Iran's interim leadership escalates faster than expected. Hormuz reopens, oil retreat, and the war premium evaporates. The Fed stays hawkish, prioritizing inflation over accommodation, and the 5-month downtrend reasserts itself. A break below 60K would expose the 50K to 55K range. Remember, Bitcoin is still down 47% from its all-time high. The base case, and this is what I think is most likely, tensions remain elaborated but contained. No full-scale grand war, but no quick resolution either. Bitcoin consolidates between 65K and 73K through March. Volatility stays high. The real breakout in either direction comes when we get clarity on two things: how long this war rests and how the Fed responds. So here's the bottom line. This is not a dead cat bounce. This is the market repricing Bitcoin as a completely era asset. The coins that retail dumped 63K out of fear being methodically accumulated by Gulf wealth funds and the U.S. institutions positioning for wartime inflation. So 70K to 72K short squeeze clustering is the next battlefield. If it breaks, 80K is in play. If it holds, expect a choppy action between 65K and 70K until the fog of war lifts. Until then, volatility is both your friends and your enemy. If this analysis was helpful, hit the like button, subscribe, and turn on notifications. For deeper dives, check out the AlphaNote blog, link in the description. Thanks for watching. I'll see you in the next one.